rough stretch, to say the least, financially. Sky-high gas, inflation, a tumbling stock market. Now, interest rates racing up. It's a lot to make sense of. Joining us on the floor to help you see some light here in this growing tunnel is Senior Wealth Advisor Brad White. Brad, thanks as always for joining us. A lot of noise out there, a lot of concern for people. I want our viewers to be able to take a little bit of breath, to be able to see things clearly. So why don't we walk them through a little bit of this? First off, inflation, why it's happening and what it means.
Yeah, well, look, everybody I think has heard, or academically people understand that economies go in cycles, right? But it's really hard to separate academically, I know something, versus I'm living through the tough part of that.
Yeah.
But it's true, economies are inevitably going to be in the dumps where we've got to do things as an economy to lift them up. Stimulus like 2008. There's other times where economies run way too hot and they need to be slowed down. That's where we're at right now, right? Inflation's the hottest rate it's been in 40 years. We have to slow the economy down. You have to remember that there's only two ways to neutralize inflation. You either have to increase the supply of things, because that'll bring prices down, or you have to hurt the demand of things to bring the prices down. When you hurt the demand, that is kind of the AKA a recession. So if you break down inflation, you've got gasoline and oil is a big part of it. And this is for a whole other topic. And we don't want to get political about it, but we've decided not to produce more oil. So we're not increasing supply. Plus we have what's going on with Russia and Ukraine. We've got supply chain disruptions, especially in places like Asia that still has COVID lockdowns. So that's not helping supply. Rent and housing, which has gone skyrocketing. Well, guess what? We're 4 to 5 million homes short in this country, which is something we've talked about on air here, Carlo. So that supply can't instantly get fixed. Employment is full. That's already a full supply, which means you have employees demanding higher wages, and employers basically just have no choice but to pay it. So of all the things I said, right, it doesn't seem like increasing supply is a fix, and our government knows that. So what is the other thing that we do? The Fed raises interest rates.
Right.
When the Fed raises interest rates, it slows an economy down. It slows down housing demand, right? Because it's more expensive for housing. It slows down business investments, right? Because businesses, if they're paying a little bit more in other areas, they can't hire as much. It causes people to spend more money on all these other items, which they can't spend on the demand in other areas. So that, Carlo, is what's happening with inflation. We've talked on air about why inflation happened post-COVID. And how do we neutralize it? Well, because of the things that I just talked about, the Fed raising the heck out of interest rates is kind of the reason to try to do this.
And we're all hearing it. It's likely there's going to be a recession. I have a little bit less than a minute here. One thing, though, is recessions aren't always, they're not all built the same. What do you see right now when you look forward at the possibilities right now?
Yeah, well, I'll make it quick then on this. So I think we're very likely going to head into a recession in 2023. But you really have to remember, not all recessions are created equal, right? 1929, Great Depression, 2008, Great Recession. The 2008 was such a PTSD, right? That's the recent recession. It was so bad that I think a lot of people hear the word recession and it instantly takes them there, and I understand why. But here's my kind of point. The average market drawdown post-recessions or around recessions is around 29%. The median is 24%. Guess what? As we sit here today, the markets are down 22%. So trust me when I tell you that the markets have built in a strong possibility for a recession in 2023. They're not building in a 2008 like unbelievable recession, because there's a lot of other good things in our economy that suggest that it's far better than what happened in 2008. But no question, inflation is not going to get fixed. We've talked about this on air too for the next year or two. People have the right to feel nervous. It's not a great environment, but we've already seen a big part of it built in.
Well, Brad, we're going to hope that, as you said, it's not as bad as what we saw in 2008. Everybody's got their fingers crossed. Brad White, Senior Wealth Advisor, appreciate giving us just a little guidance on this, people to understand what they're hearing with all that noise out there. Appreciate your time.
Happy to be here, Carlo.
Heather?